All right, welcome to this explainer. Today we're unpacking a massive contradiction in the market, and that is Caris Life Sciences. This is a tech bio company that is sitting on an absolute potential goldmine. But if you look just under the surface, it's waving some pretty serious red flags. So we are going to break down exactly what the data is telling us. Because on one hand, you've got this molecular profiling pioneer using AI and machine learning that is just crushing its revenue goals. But then on the other hand, you have a stock that has completely punished its investors.
Look, let's just dive right into the heart of this paradox. How does an AI-powered biotech company grow its top-line revenue by an astounding 85.37% in a single year, but watch its stock crash 46%? We're talking a drop from its 52-week high of $42.50 all the way down to the $22 range. I mean, think about that. Over the past year, while the broader S&P 500 marched upward by over 21%, Caris actually fell by more than 21%. That is a massive divergence between business performance and stock performance, and it tells us right off the bat that the market is deeply, deeply conflicted here.
To make sure we cover all the key points today, let's start by unpacking the bull case. There are 7 major green flags driving optimism for this company, and honestly, the top-line numbers are simply staggering.
Right, so the first massive green flag is that explosive 85.37% revenue growth over the past year. Just to put some real dollars behind that percentage, their Q1 2026 revenue hit $216.2 million. By Q2, that jumped to $263.7 million. And the forward-looking projections, that's what really has people talking. They're expected to break the massive $1 billion revenue mark in 2026 and then climb even higher to an estimated $1.21 billion by 2027. It's huge growth.
And it's not just hollow top-line growth either. They're executing brilliantly on their unit economics. They beat Q2 analyst estimates by nearly 11%. But even more impressively, they're maintaining a nearly 70% gross margin. Basically, for every dollar of revenue they bring in, they keep roughly 70 cents after the direct costs of goods sold. When you pair that efficiency with a 20.13% return on equity, well, you can start to see why Wall Street analysts have a consensus buy rating on the stock. They're targeting an average price of $26.75, and some firms like BTIG are seeing upside all the way to $33.
But here is the crown jewel of the entire operation. This is the underlying engine of the whole bull case. They have this self-reinforcing clinicogenomic database that competitors just cannot easily replicate. In 2025 alone, Caris completed over 199,000 clinical therapy selection cases. And every single one of those cases feeds their AI engine, which they call Dean. It's a classic flywheel effect, right? More data makes the AI smarter, a smarter AI attracts more customers, and those customers generate even more data. It is a true, undeniable technological moat.
And corporate insiders? Yeah, they are betting big on this exact data moat. Over the last 24 months, insiders have purchased 99,050 shares. They're putting nearly $1.5 million of their own money into the stock. Just recently, directors John Halbert and Jeff Elvacirca placed massive informative buys. You know the old saying, when the people inside the building are spending their own cash to buy the stock, it's generally a very strong signal of internal confidence.
So, the multi-million-dollar question is, if the growth and the data are really this good, why has the stock cratered? Let's pivot sharply and look at the bear case, because there are 7 hidden warning signs we need to talk about.
Okay, the most shocking red flag, and frankly the biggest weight around the neck of this stock, is the massive dilution. The company increased its outstanding shares by an unbelievable 559% year over year. They now have over 282 million shares outstanding. What this means in plain English is that existing shareholders own a much, much smaller piece of the pie today than they did a year ago. It strongly suggests the company is relying heavily on issuing new stock to finance its explosive growth rather than actually paying for it with generated cash flow.
And that massive dilution is masking a highly concerning financial foundation. The stock trades at a trailing price-to-earnings ratio of 61.3x. That means it is priced for absolute perfection. Guru Focus gives it a financial health score of just 14 out of 100. Why? Well, they have a history of brutal net losses. We're talking a negative $68 million net loss in fiscal 2025 and over $280 million the year before that. Add in some very thin interest coverage on their $452 million in debt, and short sellers taking up over 4% of the float, and you can clearly see why the smart money is heavily hedging its bets here.
So how do we impartially weigh this out? How do we balance explosive top-line growth against staggering share dilution and historic unprofitability? To figure this out,
we're going to run Caris Life Sciences through the ultimate value investor gauntlet. We're testing it against the most rigorous financial frameworks ever designed.
This situation creates such a fascinating tension. On a purely quantitative level, the algorithms rate their economic moat a 1 out of 10. The raw numbers say they have no durable advantage whatsoever because they just aren't turning a consistent profit. But the qualitative reality completely misses the immense real-world value of their big data advantage. Basically, the market is pricing them like they're some standard struggling diagnostic lab, but under the hood, they are actually the premier big data play of the biotech world.
But when you test it against those legendary investor frameworks, honestly, it's a bloodbath. Benjamin Graham, he issues a hard pass. The stock only meets 2 of his 7 defensive criteria because the PE and price-to-book ratios, which is sitting at 10.86x by the way, are just sky high and there's zero dividend. Warren Buffett also rejects it. The 10% return on invested capital falls way short of his 15% minimum, the earnings are inconsistent, and a complex AI tech bio model is way outside his preferred circle of competence. However, Peter Lynch might actually keep this on a watch list. Sure, the 61x PE is incredibly rich, but that raw 85% revenue growth paired with nearly 70% gross margins, that is exactly the kind of growth at a reasonable price dynamic that would pique his interest, assuming the valuation ever cooled down.
So, where does this leave us? Where does it leave you, looking at this high-growth, data-rich, but currently unprofitable and highly dilutive tech bio story? Well, it really all comes down to your personal investment philosophy and your tolerance for risk.
The takeaway from all the source material breaks down like this. If you're a strict value investor demanding consistent profitability, low multiples, and a crystal clear path to free cash flow, the Graham and Buffett disciples, this is a hard pass. If you're a Lynch-style growth investor, you probably put this firmly on your watch list and just wait for profitability to stabilize. But if you are a speculative growth investor and you are betting on AI and big data monetization, the upside is firmly on the table for you. Those gross margins and that data moat are incredibly real, and they'll be incredibly valuable if the company can properly monetize them.
Ultimately, you have to ask yourself one critical question when analyzing Caris Life Sciences. Can this company translate its world-class clinicogenomic data into consistent bottom-line profitability before the massive share dilution entirely erodes shareholder value? Basically, it's a high-stakes race between the AI flywheel spinning up and the printing press churning out new shares. Which one do you think crosses the finish line first?